Sam, I want to pivot to you and talk a bit about real estate because that's one of the most popular things we come across, particularly people that live in the US and own a home there and are planning to move to Canada. What are the general implications of the timing differences there? So, for example, moving to Canada and then selling the house versus selling the house and then moving to Canada. How should people plan for that?
Yeah, we do see that for a lot of our clients as well. Oftentimes, there's a lot of different factors to consider. One of them, the first, I would say main issue is the issue of tax residency, and having a U.S. property still could still consider you could still be considered a U.S. tax resident if you still own the property and you're living in Canada and you're traveling back and forth. So one of the main reasons why you'd want to ideally give up the property on or in or around your move date is it's to sort of cut those residential ties. Even if you have a property in Canada, depending on the laws in a particular U.S. state, you could potentially be seen as a U.S. tax resident. For example, if you have a property in certain states like New York or California, and you travel back there, there could be additional layer of state taxation. So it's important to sort of sell the property ideally, or to avoid potential tax residency issues in particular states. Um, Another issue is that if you do move to Canada and you own a U.S. property, it could potentially be subject to Canadian taxation, and you might not be able to get a principal residence exemption. Um, the property for Canadian tax purposes would only be taxable on any gain that accrues while in Canada. So there'd be a step up in the cost base equal to the fair market value of the property on arrival to Canada. You would need a appraisal in order to establish the cost base for Canadian tax purposes, and reporting that in Canada, which is a little bit more work, as if instead of just selling it prior to moving to Canada, then it wouldn't be reportable at all for Canadian tax purposes. The other issue for U.S. tax purposes, in order to get the U.S. principal home exemption, which the IRS has, it's 250,000 or 500,000 if you file jointly. You have to have lived in the property for a minimum of 5 years to be considered eligible for that exemption. So if you move to Canada, let's say, and you decide to, rent it out for a few years, if you don't, if you've never lived in it for 2 of the last 5 years, you might not be able to get the full principal residence exemption. So it's important to sort of consider that as well if you do decide to keep the property and rent it out. So there's a lot of different sort of factors that we would need to consider depending on the individual's circumstances, um, and also their U.S. status. If they're non-residents of the U.S. and they're not citizens, and they were only in the U.S. under a work visa, there's additional withholding requirements as well. If you're not a U.S. person and you're living in Canada, they're called FERPTA withholding requirements, which requires a holdback of a certain amount, 15% of the gross value of the property, and then you have to wait to get that refunded back. So a lot of different issues that should be addressed well before you actually decide to sell the property.